Hello, everyone, and welcome back to another fine episode of Behind the Raise. I'm Martin, COO of Virtual Ad, and this is the show where we pull back the curtain on what actually drives capital raises. Today is a solo episode, and it's one I've been wanting to do for a while because this topic is very near and dear to me and at the core of everything we do. And it's all about the psychology behind retail capital decisions. So on this show, we talk a lot about ads, funnels, automations, creative, and all of that matters. But underneath all of it is one question that determines whether any of it works. Why do retail investors actually say yes? Not institutional investors, not VCs, but retail investors. The people seeing your ad on a Tuesday evening, reading your email on a Sunday morning, clicking invest from their phone. Understanding their psychology isn't just a soft skill. I would consider it necessary within any capital raise that you're considering doing. And if executed well, it's definitely a competitive advantage. So let's talk a little bit about some common mistakes founders can make going into their capital raise. So one of the ones that is a little bit counterintuitive, but can pigeonhole you slightly is you're building your raise around the offer. So if you're just focused solely on the terms, the projected returns, the market size, use of funds, etc., those things all matter, but they're often building exclusively for one type of investor and missing everyone else. So what we've seen across dozens of raises is that retail investors generally fall into two camps, and you're going to want to speak to both of them in your funnel. The first group of investors tends to lead emotionally. They see the founder, they connect with the mission, and something clicks. Then they go look at the numbers to confirm what they've already decided. For these investors, your story and your credibility do most of the heavy lifting. And the second group tends to lead analytically. They're running the financials, reading the offering document, comparing your deal terms against other opportunities. And these investors are real, they're common, and they deserve a raise that can withstand all of that scrutiny. So the mistake isn't ignoring one group. The mistake is building your raise for only one of them. Really, the best raises are structured so the emotional investors find conviction in the story and the analytical investors find confidence in the substance, and both paths lead to the same place. What you can't do is skip the emotional infrastructure and assume the numbers will carry it, because even your most analytical investor needs to trust the founder before they can trust the deck. And that's really an important piece, is that you need to have a really core, strong offer. Your raise won't be successful without it, but having the emotional side is how you connect with a broader audience that isn't just analyzing this deal financially. They're the ones that are buying into the broader story of what you're looking to achieve. So let's talk about the three stages of the investor journey, and that's going to be important. So stage one is curiosity. This happens at the top of the funnel. It's an ad, a social post, referral from a friend. The investor doesn't know you yet. The only job at this stage is to decide whether you're worth more of their attention. You have about 3 seconds in ads to capture that attention, and maybe 10 in an email subject line. In that window, one thing needs to happen: pattern interruption. Something has to make them stop. Not explain, not sell, just stop. Just capture their attention. The biggest mistake at this stage is trying to say too much or trying to do too much. You're really just trying to get one idea, one emotion, one reason to keep reading, and that's it. Really just trying to get them to either go to the landing page. You're sparking that curiosity to take a secondary action, but you're not trying to get them to place their investment just after seeing that first ad. You need to lead them down a bit of a path. And so if you've built the curiosity effectively, the stage that comes next is trust. So this is the middle of the funnel, and it's really one of the most important stages. So at this point, the investor has opted in to some degree. They know who you are. Now they need to decide if they believe you. And belief is really built over time through repetition, through consistency, and through what we call familiarity signals. And here's a stat that reframes how I think about the entire funnel. So an overwhelming majority of investors that close outside of the last month in what we call a self-directed checkout experience. So this is an experience where they will typically see an ad, they'll sign up to the investment via a landing page and go through the investment process. They don't really speak to anybody through this process, but they're really making that investment decision based on the information that they're given during that time period. So that's called a self-directed checkout experience, very common in a Reg CF or a Reg A. Overwhelming majority of investors that, again, are closing their investment outside of that last month. So this could be within, a 10-month raise. these people that are investing before that last final month tend to invest within 48 hours of entering the funnel. So that's actually a pretty short time frame. You would think that there's more consideration in the process, but it's actually pretty speedy. So you'd have people that sometimes, they see the offer, they might invest in 2 hours or 24 hours, but really like the average is 48. And so think about what that means. That means they're not sitting in the nurture sequence for 6 weeks, slowly warming up. They're arriving with a high degree of conviction already formed. That means the ads they saw, the content they consumed, the impression your brand made before they ever opted in, that's really what's doing a lot of the work and the heavy lifting. So the first 48 hours of their funnel experience is largely shaping whether they invest or they don't, which kind of means two things. First, your top of funnel work matters more than most founders realize because conviction is still being built before the opt-in, not after it. And second, what someone encounters in those first 48 hours inside your funnel, the welcome email, the landing page, the founder video, that's not really a formality. That's actually the close. And so this is often sometimes where some founders can get tripped up as well, because what we take from that is that this 48-hour close period is really where you speak to your high conviction investors. And people that don't close within that window tend not to be interested. It's very difficult to then convert somebody that hasn't shown a high degree of interest in that time period. And generally, if people don't close within those first 48 hours, you have to catch them later in the funnel, which can be during some sort of urgency period or maybe at the end of the raise where there's that ultimate urgency. But it really shows you the amount of work that the marketing is doing within that first 48-hour period. Okay, so now you've exited the trust stage. You're moving towards stage 3, which we call conviction. So this is where the investor moves from I like this to I'm doing this. And conviction is almost always triggered by one of 3 things. First one being social proof. Other people are investing, raise is growing, and there's visible momentum. 2 is urgency, a real deadline, a milestone closing, a cap being reached, not fake scarcity, but real scarcity, something that they are going to miss out on. It's kind of like the feeling of FOMO and urgency is a big driver. And the third is identity. So the investor decides that being a part of this actually aligns with who they are or who they want to be. And this is more powerful than a lot of founders realize. People don't just invest in businesses, they invest in what they see as a version of themselves. Their money is basically reflecting who they want to be in the world. And that's why something like a tagline like join the movement can often outperform earn strong returns in certain raises. I would say this is particularly effective if you are a growth company, and raises where this is tougher to pull off, I would say, is like real estate raises, for example, where those actually are a lot more centered on returns. But if you're a purpose or mission driven company, the identity factor can really open up a whole new audience to you. And I would say like an example of this is sustainability space, where there's a whole audience that tends to be aligned with that as a cause. And so if you are a company that's focused on sustainability, you might find that there's 3 different types of segments of investors. You might have people that are financially motivated, you might have industry insiders, and then you have ones that want to support sustainability as an overall broad initiative. And that's really where that identity piece comes in. Those people might not have anything to do with the technology that you're building, or they're not familiar with, let's say, a robotic solution that you have. They might not be financially motivated, but they're more so motivated by the cause. So that's really the third piece there, identity. Let's get into that in a little bit more detail, actually. So for example, when a retail investor puts in 1,000, 5,000 or 10,000 into a private company, they're not just making a simple financial transaction. To them, it's making a statement. And it's something that they often want to tell people about as well. So, like I invested in a company building sustainable housing, or I got in early on a brand I believed in before anyone else knew about it. So those are really identity statements, and they're enormously powerful because they tap into something much deeper than just financial logic. And even think about the companies that do this best in public markets. People don't just, for example, buy Tesla stock. They identify as Tesla investors, or early Airbnb investors didn't just own equity. They really felt like they saw something that others missed. And you can kind of see that across the board as people invest in these companies that are really shaping new categories. And you can build this into your raise deliberately. It all starts with how you're framing your mission. Is it something an investor would be proud to tell people that they're a part of? And it continues through every piece of content that you build out after that. So As a founder, ask yourself, when my investors tell their friends about this raise, what type of story are they telling? What does investing in your company say about them? If you don't have a clear answer to that, your messaging needs a little bit of work. So let's talk about a little bit. What does this actually mean practically? So number one, you're going to want to restructure your messaging. You don't necessarily need to lead with returns. Again, there's certain spaces where I think leading with returns does work. That tends to be the real estate space where the returns are a lot more predictable. As a growth or operational company, it's more difficult to predict the returns, and it's a lot more about the type of growth that you're going to go through over the next couple of years. And sometimes the exit path isn't as clear as it is in real estate. Those types of companies, you really can lead with mission. You can lead with the problem, lead with why do we exist now, and let the investor really fall in love with the idea before you even show them a number. Sometimes people can intuitively understand where your company's going, even without necessarily seeing a financial statement or a balance sheet, because of how powerfully you can communicate that. And I'd say, example of this is our capital conversion framework that we use at Virtual Ad, which follows a similar logic, which really is mission, problem, TAM, which is total addressable market, solution, leadership, social proof, and C, call to action, in that order. Returns are embedded in that, but they're not necessarily the lead. Belief is the lead. And once belief is established, your analytical investors have everything they need to run the numbers and essentially close themselves. So also, practically speaking, think about the first 48 hours like they're the most important part of your funnel, because to a certain degree, they really are. If the data tells us that investors who convert are doing it within 48 hours of entering the funnel, then your welcome sequence, your landing page experience, and your first email aren't just onboarding. They're really like the closing sequence, and you have to treat them as that and see that as what it is. And that doesn't mean that the long-term nurture is worthless. You absolutely need a sequence for the people who don't convert immediately, but don't mistake a long nurture for a conversion strategy. So the investors who are really ready will decide fast, and your job is to make sure everything they encounter in that first window, the welcome email, the founder video, the offering page, is all sharp enough to meet the conviction they're already carrying. For everyone else still warming up, so you can want to stay consistent, keep showing up, and let momentum do the work over time. Because again, if people don't necessarily convert in those 48 hours, maybe they had a lower sense of conviction, but there's going to be other opportunities where they can convert. They might convert at the end of the month, at a particular milestone, or even at the end of the raise. So you can definitely keep them warm, but that 48 hours is really a prime time. Number three, you want to use every milestone your raise hits as like a psychological trigger for undecided investors. 2 million raise tells them other people made this decision. 5 million raise, number of investors tells them this is a real momentum, and they might be missing out. So it's important to announce every milestone, email your list, post on social, update the landing page. And you're not really bragging, but you're using social proof because it's one of the most powerful psychological levers available to you. And you also want to show people the level of momentum so that they can see the trust and they see that things are going to work out. So it's almost like you want to be able to communicate that to people because there's a higher degree of success at that point. And lastly is you want to make sure that you want to humanize, I would say, the founder's component of it, especially if you are in a space that can be really like tech heavy. It can be tempting to focus specifically on the technology because that's really the most transformative piece. But raises that we've seen do really well when there is a strong technology piece actually harness some sort of human element or human storytelling component. And that's mainly because retail investors, they're not just funding entities, they also are funding people, especially at these early stages. So a 60-second founder video filmed on, honestly, an iPhone that's very authentic, direct, human, will sometimes outperform a heavily produced video because investors, they want to look at you and decide, do they trust you? Are you telling the truth? Do they believe in you enough to hand you their money? And ultimately, the more authentic, human, and available you are, the higher level of trust there is. So ultimately, if you're going to take one thing from this episode, I want it to be this: your investors are not all making the same kind of decisions. Some are buying with conviction and others are confirming with data. Some are building a financial case and need the story to hold up under scrutiny, and most are actually doing both simultaneously. The raises that win are built for essentially all of them: a story compelling enough to create belief and substance solid enough to reward the investors who go looking for it. And that's what we build at Virtual Ad. And this is what we're here to show you and help you to do. So that's it for today's episode. Hopefully you've all found that helpful around the psychology of retail investing. If this one resonated, share it with the founder who's in the middle of a raise, thinking about starting one. This is the kind of foundation that changes how, you can approach a raise. And hopefully you'll be joining us next week for another episode where we have guests joining us, and I won't spoil the surprise, but it should be an absolute banger. Very excited for it, and looking forward to seeing you guys next week.